Good afternoon, everyone. Thank you for joining us today for the Financial Risk and Rewards of Retirement Communities. We have a pretty large attendance today, so we're going to give everyone about a minute to join us today, and then we'll introduce our two presenters, give you a little information about our communities, and then go through the presentation. That will be about an hour today, so we'll go right up to about the 2 o'clock time frame. And hopefully have a chance to answer some questions before the end of the hour. So we'll get starting in just a minute once we get everyone joining us momentarily. All right, I think we'll get started today. So again, thank you everyone for joining us. My name is Dan Witham. I'm a senior living counselor for the RiverWoods Group, representing our 3 RiverWoods communities today. Again, this is the Financial Risk and Rewards of Retirement Communities presentation. So over the next hour, we're going to have 2 wonderful presenters, Keith Robertson, who is the managing director at Ziegler, which is Capital Group, the nation's leading financial underwriter for financing nonprofit senior living providers. So Keith will be taking a good chunk of the presentation today to talk about that side. And then we also have Kevin Goyette, our CFO from the RiverWoods Group, joining us. And Kevin is responsible for the financial oversight within RiverWoods Group's system of communities to include investment management, debt insurance, audit, and future development financial analysis. So we have 2 wonderful presenters that will give about 20 minutes each, plus or minus, of some great information for you to learn about, again, the financial risk and rewards of retirement communities today. For anyone that's new to any of our presentations, a few housekeeping notes before we get started. Everyone will be on mute today, so because we do have a large group of individuals joining us. Anyone that has questions, we generally like you to reserve your questions because a lot of information will be covered before you submit your questions. But if you do have a question, submit them through the Q&A box. That's generally located at the bottom of your screen on most computer systems. It might be different on your phone if you're looking at a phone today. So submit your questions, and we'll do our best to get to as many questions regarding today's topic, especially for our 2 presenters. We also like suggestions on ways to improve our program. So if you have any suggestions, put them in the Q&A box, or an idea for a future topic or a suggestion for a future topic, as we really try to define many different topics that pertain to our retirement communities. For some of you today, you might be new to learning about a CCRC, or continuing care retirement community, or life plan community. We hear that new name quite often mentioned. We are basically an insurance product regulated by the state of New Hampshire Department of Insurance here at RiverWoods, where residents move into our community as independent residents, enjoying all the aspects, or what we call lifestyle choice, of finding a community. So you enter while you're independent, enjoy all the aspects of maintenance-free living, transportation, dining, activities, programs, and really stay in control of your life. But with that future need of healthcare, where you would go to any of those higher levels of care in our communities, from assisted living, memory support, or nursing needs, as your needs change. We also offer short-term respite stays, so a temporary stay in healthcare as well. We have a predictable monthly service fee that covers the cost of living in the community, and an entrance fee, a portion which is also tax deductible, along with that monthly service fee of living in the community. So an entrance fee when you first buy into the community, and that monthly service fee. Currently today, RiverWoods, as we stand, is a system, or 3 not-for-profit communities located in 3 different areas, all in the state of New Hampshire. So RiverWoods Exeter, our founding community, is 30 years old as of this year. Just celebrated our 30th anniversary of the Woods campus at RiverWoods Exeter. We have RiverWoods Manchester in 2016, formerly Birch Hill community, and then RiverWoods Durham, our newest community, opened in November of 2019, so coming up on 5 years of age. So these are our 3 not-for-profit system of communities here in New Hampshire. RiverWoods, because we are a not-for-profit system of communities, has a CCRC board, Continuing Care Retirement Community Board. That's our governing body for an organization. They report to our system CEO, Justine Vogel. She has just celebrated 30 years with RiverWoods this year. So she's very well connected across the United States, and of course, with our RiverWoods system of communities. We also have the RiverWoods Group that provides professional fee-based services to each of our 3 communities, things like finance, IT, human resources, quality control, and marketing. The RiverWoods Group also funds any at-risk portion of projects in our communities or new ventures. And then again, just to note, each community is financially independent of one another, but does have the opportunity to give additional funding to the RiverWoods Group. One more slide, just a note when you're looking at communities, whether it's in the state of New Hampshire, around New England, around the country, you're going to learn a lot about our RiverWoods system of communities today from Kevin, our CFO, but really look for things that are important. RiverWoods is very independent, forward-looking. We are a family of communities, so not just one standalone. We also are highly rated. Our RiverWoods Exeter campus and communities are CARF rated, which is accreditation system for communities across the country. Currently has an A- rating and just got reaccredited for the next 5 years as well. And that consistency or quality of our board of directors and management and within our communities. So things to look forward to. And again, we have a great presentation for you to learn today from the financial risk and reward side. So I'm going to introduce you our first speaker, our presentation from Keith Robertson. Again, he's the managing director at Ziegler. So Keith, the floor is all yours.
Great. Thank you, Daniel. If you could turn to the next slide. So today we're going to talk about the topics that are on this slide. But actually, before we dig into the topics, just to give you a high-level overview of who Ziegler is and who I am. So Ziegler is a boutique investment banking firm that Daniel mentioned, but we are focused solely on mission-driven businesses, so healthcare, education, and senior living. And I'm in the not-for-profit senior living sector or space of the firm, and I dedicate 100% of my time to working with not-for-profit senior living organizations like RiverWoods. I cover the Northeast, so New York, New Jersey, and New England. And I would say the Northeast region is among the most dynamic region that Ziegler covers. So very active, very, let's say, knowledgeable resident population. So having conversations like this are just a lot of fun because folks generally understand what we're talking about. So some of the things that we're going to talk about today are on the demand side of the equation. So the demographics, the number of folks that are currently being served and that will certainly be there to serve in the future. The biggest challenge that organizations like RiverWoods are facing right now is workforce. So we're going to spend some time talking about the workforce challenges. We're going to talk about the supply side of the business and frankly how the sector is doing right now in terms of occupancy and health. I'm going to talk a little bit about growth, specifically on the affiliation or mergers and acquisitions side of the business, as well as future growth opportunities within the sector. Some of the changing environment within healthcare and skilled nursing. We don't have a specific slide on in here about skilled nursing, but we are seeing a significant decline in skilled nursing among the not-for-profit sector. It's a very challenging business, and many organizations across the country are disposing of or shrinking their exposure to skilled nursing, primarily those that are working within Medicaid populations and focused or receiving third-party reimbursement from the government. Organizations that are primarily private pay in skilled nursing are keeping their skilled nursing and some are even expanding it. Some of the things that we talk about a lot are home and community-based services. It's a great opportunity for organizations like RiverWoods to potentially serve more people without necessarily going out and borrowing any additional money and taking on the risk of building a new building. However, the biggest challenge that we're seeing on the home and community-based service side of the senior living sector is how to staff it. We're going to spend more time on staffing, but I do have some organizations that I work with that have actually shrunk their home community-based service offerings because they're just unable to staff the offering. Technology and innovation is a big driver in our sector right now. It sort of goes along with with scale. We talk about scale a lot in our business. Larger organizations are doing better from a financial perspective, but also from an operational perspective as it relates to technology. The larger organizations, and RiverWoods is one of those organizations, have the capacity to do technology better, to have a group of folks that specialize in technology, understanding it, and then being able to assess the strategic needs of the organization and find technologies that fit those strategic needs, and then ultimately fund it and then implement it. And then beyond that, keep up with the changes. So large organizations like RiverWoods are doing great when it comes to technology. Some of the smaller single site communities across the country and in the Northeast are struggling to implement some of the technology solutions that we think are a key driver for future success. And we're going to talk a little bit about the actual health of the sector. Next slide, Daniel. All right, so this is the slide that I like to start all these presentations with. I think there might be a fly-in, Daniel.
Yes.
I always forget the fly-ins, but so we all talk about the age wave, the baby boomer generation, but the numbers are real. So over the next 10 years, the number of folks who will become 75 or older is going to go up by about $12 million. If you look back 10 years, the numbers have increased about 20 million. And then if you go out to roughly 2044, so another 20 years from now, again, about 20 million additional folks turning 75 and older. So the number of folks that are available for organizations like RiverWoods to serve is significant. That significant number creates a lot of opportunity. It also creates a lot of risk, especially as it relates to our next topic, which is staffing. So we have a lot of opportunity. Organizations like RiverWoods see this demographic slide and see a lot of opportunity, but then it raises the question, how do we staff those programs? The other types of organizations that we're going to get in today, a little bit about the for-profit versus the not-for-profit difference. The for-profit organizations going back to 2011 or 2012 saw slides like this and saw an opportunity to make money. So the for-profit side of the senior living sector has grown significantly post-financial crisis, and it's really looking at slides like this where they see opportunity to make some money. Next slide. So how is the sector doing? The sector is generally doing quite well, although it hasn't fully rebounded from an occupancy perspective to where we were pre-COVID. So here we have the multiple levels of care that not-for-profit organizations work within, so independent living, assisted living, memory care, and skilled nursing. And you can see that there is improvement in occupancy over the past year. So focusing on the second quarter of 2024, comparing that to the second quarter of 2023, we see fairly significant increases in occupancy across all levels of care, especially on the assisted living and memory care side of the business. So we do see improving occupancy getting up around 90%. On the independent living side, we've been over 90 for a while. But if you go, there's some other slides that we have in here that look back further. We still haven't gotten to the same stable occupancy levels that we had pre-crisis. So going back to 2008 and 2009. So we still are struggling with occupancy. The number one occupied market in the country is Boston. So from an occupancy perspective in our region in the Northeast, the Northeast region is the strongest in the country. Looking at skilled nursing, so occupancy percentages have increased among the not-for-profit space. We don't necessarily, from our research, we don't believe that it's more folks living in skilled nursing. What's actually changed on the skilled nursing side is the denominator has shrunk. So a lot of not-for-profit CCRCs, life plan communities have been shrinking their skilled nursing offering or potentially even getting out of skilled nursing altogether. So even though occupancy percentages are up, it's primarily driven by the reduction in the number of skilled nursing units. Next slide. I think there's a fly in here as well. So talking about comparison to the for-profit sector. So generally the not-for-profit CCRCs are stronger from an occupancy perspective than the for-profit counterparts. And you can also see, so there's roughly a 3 percentage point difference, but during COVID, back in early 2020 through 2021, the not-for-profit folks occupancy declined fairly significantly, but not as much as the for-profit sector. So the for-profit sector, I would say their occupancy levels are generally not as the phrase we use is sticky. They are generally folks moving in and out of for-profit organizations more rapidly and more frequently. On the not-for-profit side, primarily driven by the entrance fee model, generally has fairly stronger and stickier occupancy. So right now, on the not-for-profit side, occupancy among life plan communities is roughly 90%. In the Northeast, that number is closer to 92%. But if you look back to 2006 and 2007, where average occupancies averaged around 94%, there's a decline around 2009 and 10, which was driven by the financial and real estate crisis. And occupancies leveled out right around 90 to 91%. And then we crept up maybe to 92% on average, but not as high as the 94% average occupancy that we enjoyed. And we still haven't gotten back to those same levels. I know organizations like RiverWoods, where I think your average occupancy is north of 95%, very, very strong and stable. But the real driver with occupancy is low occupancy is generally the first sign of financial distress. There is a lot of news right now about financially distressed CCRCs. And occupancy, I would say, is one of the primary drivers of financial distress. So next slide. All right, so Ziegler does a CFO hotline every year where frankly, sometimes every month, sometimes every quarter. And we ask not-for-profit CCRCs across the country questions. And one of the questions that we ask every year is, how does your organization plan to grow? So growth is a major driver within the industry. And we like to see organizations grow, build scale so they can weather some of the challenges that have come our way, challenges like COVID. And the large organizations generally do it better. So we ask the question of how folks are growing, and the number one way organizations are growing is through unit expansions. What these expansions generally look like are a stable community. They might have a wait list, but they also require significant reinvestment back into a campus because it might be older or dated. And they use new units. So add 20, 40, 60 new units to help fund some of the debt that would be incurred to reposition the current campus. So that's where most of the growth that we're seeing across the sector is coming from. I would say in 2000 through 2007 or 8, most of the growth that we experienced was through new campuses. Most organizations were building new campuses. Coming out of the financial crisis, most organizations have steered away from new campuses. So right now, of the CFO hotline respondents, about 240 organizations are polled. About 18% of those are considering new community development. This is the largest this number has been in a long time, meaning organizations are starting to think about the future and starting to think about building new campuses. At the same time, where you take construction off the table, some folks don't like the construction risk. They look to grow through affiliations or acquisitions. In general terms, on the for-profit side of the world, they call this M&A activity, so mergers and acquisitions. And about a third of the organizations that we polled are looking to grow through some kind of affiliation or acquisition opportunity. This is it's a great way to grow. RiverWoods has grown through an affiliation, affiliating with Birch Hill Terrace back in 2016 or 17. So it's a great way to expand, serve more folks, frankly, help those who might not necessarily be as financially strong without taking on the financing risk or the construction risk of building a new building. And then all the other risks that come with building a new building, primarily filling it and then stabilizing operations. So we like to see organizations growing. We like to see organizations that expand their mission, serve more people. And the way that the sector itself is growing right now is fairly effective, although we would love to see more organizations looking at building new campuses. Next slide, please. So when I do presentations like this, I often will spend a lot of time on this slide, but this is a slide comparing the not-for-profit growth compared to the for-profit sector growth. In terms of expansions, it's roughly even between the not-for-profit space and the for-profit space. But the for-profit organizations that serve seniors, they are growing significantly through building new campuses and building new units. Whereas the not-for-profit sector really hasn't fully embraced the concept of building new campuses. So what this means is that as that demographic wave is coming our way, there are folks for RiverWoods and other not-for-profit providers to serve. The for-profit industry is looking to capture those folks. Generally, the for-profits sector, and there are some really good players on the for-profit side of the world, but they're not necessarily there for the people. They're there for profit. It's really in the definition. Organizations like RiverWoods and other not-for-profit providers, any money that's generated stays within the organization, only enhances the balance sheet. It doesn't get offstream to pay shareholders or to pay dividends. So ultimately, the not-for-profit sector generally is more focused on people. Most of them have a charitable mission, and if someone runs out of money, we'll generally allow them to stay. On the for-profit side of the world, it really is the driver is profit, really exactly as it states. Not saying that there aren't really wonderful for-profit providers. It's just really what drives them is what's different. Next slide. So I want to talk a little bit about or go into more detail about affiliation, acquisitions, opportunities. So going back to 2010, there's been over 1,000 not-for-profit senior living organizations that have closed, or I'm sorry, that have changed hands through the process of roughly 700 overall transactions. So some of those affiliations are actually systems that move. So there's been a lot of activity, but since 2015, 46% of that 865 units that have transitioned have ended up in the for-profit sector. So the for-profit providers generally have easier access to private equity, allowing for a very efficient acquisition process. Not-for-profits have a fairly slow process of issuing tax-exempt debt. You can't necessarily use tax-exempt debt to acquire independent living units. So there are some IRS restrictions as well. So it's hard for the not-for-profit sector to be competitive when you're looking at a smaller distressed situation. Most of those end up in the for-profit sector. So, but a lot of activity. We like this type of growth. It's more organizational growth, not necessarily driven, or it doesn't help drive industry growth. So we would like to see organizations focus both on new campuses, expansions, as well as mergers and acquisitions. Next slide. Oh, you know what? So here's the updated slide. So I think so going back. So this just includes 2024 compared to the last slide. We can skip. All right. So sector consolidation is a major driver. Going back to the early 1980s, about 50% of the communities were a part of systems, and the other half were single sites. Over time, we're seeing a significant shift away from single site activity, more towards systems. Many of the systems started off as single sites. So RiverWoods is a great example with RiverWoods Exeter. The Woods campus that was built back in 1993 or 94. Ultimately built two other campuses on that site, and then affiliated with Birch Hill, ultimately developed RiverWoods Durham and became a system. So now RiverWoods is up in the dark purple section. But what we do see is sector consolidation is real. It's significant. And we do see, so right now, 28% of all the life plan communities are single sites. We see those numbers shrinking to well below 15, maybe even 10%, as affiliation activity continues to be enhanced. But we also see the smaller organizations struggling. There actually are a couple of situations that have gone sideways, and ultimately it's a true disposition. But the smaller single sites struggle. They don't have the efficiencies, the capacity, even the leadership talent to weather the challenges that are in front of them. So we're seeing a major shift towards system activity because it's that argument of scale. Scale gives organizations like RiverWoods the ability to weather challenging times like COVID. So we do see this continuing. I often say single site CCRCs are a thing of the past. On some level, I believe that. On other levels, there are single site communities that are very, very strong. They're the leader in their market. They have robust balance sheets, and they're going to be okay. But ultimately, those larger single sites at some point will probably bring in folks under their umbrella, like RiverWoods did, and ultimately form a system. Next slide, please. All right, so this slide is looking at new campus development. So right now, Ziegler is tracking about 45 new campuses between now and 2028. New campus CCRCs used to always, I would say 98% of the time, include skilled nursing. We're seeing a significant shift away from the development of skilled nursing facilities. It's a very challenging model. It's a model that many residents have indicated they don't want. Federal reimbursement or state reimbursement is very challenging. So a lot of the new campuses that we're tracking now don't include skilled nursing. So roughly a third of the new campuses that we're tracking will actually be the full complement of independent living, assisted living, memory care, and skilled nursing. But about 2/3 of the organization or the CCRCs that are being planned right now will not include skilled nursing. So it's a shift in the industry. We think it's going to continue. A lot of it is driven by state regulatory environment, but also the mission of the organization developing the new campus. Next slide. So I've already mentioned technology, but technology is a major driver, and I like to talk about scale when I talk about technology. Organizations like RiverWoods are able to navigate the technology ecosystem much better than the single site communities that just don't have the capacity or the personnel to be able to really understand it, let alone purchase it and implement it. But there's so many different types of really kind of fun, cool technology. And one that we don't really, we fully haven't embraced yet or really aren't sure how it's going to affect our lives is AI. I was doing a presentation on technology a couple of months ago, and the gentleman I was presenting with, he asked if he could create a video to introduce the session, and he introduced so we had a little video that played, and it talked about the session, thanks for coming, and all this kind of stuff. And then when he finished, he said that full video was created through AI. So it's going to be a major driver. I don't think we necessarily know where it's going to lead us, but it's going to be really fun and interesting. Some other ways that technology can help us is through workforce solutions, brain fitness, resident monitoring, concierge services, care coordination, telehealth. So there's a lot of different opportunities where technology can really make a difference, not only in the providers' lives, but also in their residents' lives. Next slide. I'm going to talk a little bit about the financing side of the world. Coming out of COVID, many organizations, life plan communities struggled. Not all. Folks like RiverWoods have thrived. Some of the larger, stronger organizations came out of COVID even stronger than how they went in. But some of the smaller organizations have really struggled. And that has resulted in a significant number of downgrades. Going back to 2020 among the Fitch rated communities. Fitch is the number one rating agency that rates senior living organizations, not-for-profit senior living organizations. But a majority of their rating actions recently have been downgrades. Part of it is financial distress, but the other part of it is organizations that are looking to grow when they build a new campus, or if they were to embark upon an expansion. Oftentimes that will result in additional debt, and the rating agency will assume that's additional risk and therefore downgrade the organization. So it's not uncommon for even strong organizations to be downgraded, especially if they're pursuing significant strategic plans. Next slide, please. So along those same lines related to Fitch and rating activity, Fitch is the primary rater among the not-for-profit senior living space. And recently, Fitch came out with updated criteria. Back in March of this year, they provided I think it was a list of 19 different criteria change. And some of it was somewhat concerning. They did have a public comment period that lasted probably 4 or 5 months, where they took in comments from the external world, other stakeholders like RiverWoods, like Ziegler, and tried to push back on some of their proposed criteria change. End of the day, they published their changed criteria on August 19th of 2024. And some of those changes are fairly impactful. They got rid of the AA category. Not that there are many AA rated communities, but anybody who was already in that category will now get pushed into the A category, which creates compression. So we do think many of these stronger organizations might get downgraded to the BBB category, not because of who they are, just because of the rating scale has changed. They have said, the Fitch has said that they don't like skilled nursing. Any organization that has a large percentage of skilled nursing is going to be on credit watch. And they've tried to be very clear with how they look at future projects. So I'd say it's a fairly significant change to the sector. It's going to affect ratings across the board. It's going to affect how bond investors assess ratings and individual credits. Could have an impact on cost of capital as organizations get downgraded. But it's a major driver for what Kevin and I talk about on an ongoing basis. So it's certainly something to keep in mind. At the same time, the rating agencies are a key measure of financial strength. So as you're looking at a potential move to a CCRC, understanding where their rating falls is important, because they do dig deep. Fitch looks very closely at credit metrics. They understand management, they understand markets, and generally their rating is a pretty good assessment of the financial strength of an organization. Next slide. And that's a great lead into this next slide. How does the industry really track performance? There aren't, I would say, great benchmarking tools out there. So it's really find the one that works best for you. But some of the tools that we recommend to residents or future residents use to understand the sector better. So Fitch is the primary rating agency. A lot of the information that they publish is not for public consumption. You have to be a member of Fitch to access it. But oftentimes, if a CCRC you're talking to has a rating, they can provide their rating report to you. And oftentimes, there are other ways to determine what an organization's credit rating is. There is an accrediting organization called CARF. Although the number of CARF accredited communities has declined significantly, therefore the metrics that they create is a much smaller sample size. Therefore, the value of those ratios may not necessarily be as strong or as healthy as it used to be. But again, some of the metrics that they look at are very important. So understanding the performance of an organization from an operating perspective, how strong their balance sheet is, both in terms of liquidity and debt. So those are some of the things that both Fitch and CARF look at. There are some other industry publications. Ziegler publishes some information. You really have to look for it, but the best way to find the best tool is to talk to the CCRC that you are looking to move into and see what they're willing to provide to you. Ultimately, transparent organizations have a lot of information that's readily available to help you assess your decision. Some of the, I would say, weaker ones are less transparent and don't want you digging deep. Therefore, it's harder to get information. The one that I use for a lot of data it's called emma.msrb.org. So the MSRB is the Municipal Securities Rulemaking Board. That's who I am regulated by. And Emma is a disclosure portal. So anybody who has public debt publishes information to Emma, and it's out there for really anybody to access. And that's what the purpose of that website was so any bond investor can find information about their investment. We do see organizations really focused on improving their disclosure because knowledge is power, especially organizations that are strong. We see them highlighting their strength. So the easier it is to access financial information on any community that you're looking at generally is a sign of financial strength. The organizations that are generally not comfortable with their financial strength try to hide the information from you. All right, so I think the next slide might turn us over to Kevin.
All right, thanks, Keith. That was a great high-level overview of the broader industry for us. And Dan, you can move it off my picture.
It's a nice picture.
That was kind of, I thought I had a mirror for a second. But this part of the presentation is going to bring it down from 30,000 feet to 10,000 feet of a level. And really what you'll see are the themes are you have choices, and hopefully at the end of this presentation, you will have the ability to be more educated on what choices are out there and what to look for communities as you go along your journey. At a high level here, uh, for as a senior, you can choose to stay home with or without services. You can choose to cohabitate with your children. That's usually not a very popular choice. You can wait and not make a decision until you need to make a decision, which would be assisted living or, as Keith mentioned, memory support or future nursing care. But really, our focus today will be your ability to choose your change now and make the choice while you're able to do that, and really focus on the life plan community or CCRCs. If you've seen one CCRC, you've seen one CCRC. They have different amenities, different price points, different unit styles, different things that are included in the contract or are not included, but that you can buy on an ancillary basis. But boiling it down, there are really three main contract types, especially in the not-for-profit space. And they really range from a type A community, which has the highest insurance component, to what's referred to as a type C, really pay as you go. If you think about it that way, fee for service, you pay a lower monthly service fee in independent living, but the day you need assisted living care, you will go up to market rate. And if you need to transition to nursing care after that, you will go up to that market rate. All different options in between here. These are all priced actuarially for the community to understand. And when the actuaries help us price contracts, they're looking at it as a risk pool, not an individual person's preference. So Dan, if you move on to the next slide, and I get asked all the time, well, what's the right choice for me? And my answer is always, well, it depends on how you look at things. If you really want known budgeting and you want to move into a community at the independent level and know that you're going to pay pretty much the same monthly service fee, regardless of what level of care you may access, then choose a type A contract. It has the highest insurance component. And while you don't have a full ceiling on your future needs, you're going to be paying essentially what you are paying in independent living. If you want to go the other end of the spectrum and say, well, I only want to pay the least amount in independent living, and if I ever do need a higher level of care, I have no problem paying market rate at that point, you'd opt for a type C contract. They're back end loaded, so the highest costs come at the end of your contract. And some people will choose this contract because in their minds, they believe they will live independently for forever, and some do. If you want to hedge your bets, the modified contract or a type B contract in the middle probably is the right one for you. And you pay for the higher level of care still at a discount to market rate when you need to access it, if you need to access it. And in the RiverWoods system of communities, we have two communities that are type A contracts and one community that offers a type B contract. Dan? Just a quick explanation of how long-term care insurance and Medicare plays in. From a Medicare perspective, it really doesn't protect you as you move forward. It's really about having a hospital overnight stays, 3 of them successively, before you can access your Medicare benefit. It doesn't answer the question of what community is there. It may supplement some of your expenses if you do need the skilled nursing aspect, but it's not the overall answer of how you can live when you want to live in a community. Long-term care insurance, that could be used as, go back, Dan, just real quick. Long-term care insurance, if you have those policies, they can help you in a CCRC, but they don't necessarily tell you where you're going to receive that service. And typically they're only for a fixed amount of benefit. As Keith mentioned earlier, most not-for-profits have a benevolence clause, meaning once you're in the community, as long as you haven't personally impoverished yourself, you have a place to stay for the rest of your life. Long-term care separately usually has a total benefits stipulation. So CCRCs really answer all the questions of what your next stage of your life looks like. Dan? Just some financial basics as you're going through your evaluation. And I'll say this presentation is available. The recording's available to you as well. So if I don't cover every last one of these, know that you can access it. Keith talked about the benefits earlier, for-profit, not-for-profit. The for-profits have shareholders. They expect to pay profits and dividends. Those profits and dividends typically don't go to the residents, whereas a not-for-profit, if it generates a positive margin, that margin goes back into the business for the benefit of the current residents and future residents. You always want to look at occupancy. I'll talk about it a little further, but it is the lifeblood of an organization. We are very spoiled in the Boston metro market with high occupancy rates because these buildings are not inexpensive to run, and the more paying residents you have, the less on average each one pays for the services we provide. Always want to look at the grounds and the buildings of the organization. Ensure they are reinvesting. Tastes change, markets change. You want a crisp and contemporary building that is aesthetically pleasing and safe and enjoyable. And the saying of a picture is worth 1,000 words. Absolutely. If you drive into a community that looks like it hasn't been taken care of, my suggestion to you is turn around, because the inside probably won't look much better. And then disclosures. Keith talked about this as well. The strong organization is especially enjoy providing financial information. They enjoy sharing their approach to the business with residents or potential residents. So look to see if the audited financials are available. Ask if you have a financial question, speak with a financial executive. If you're deferred from that, then that might be a red flag for you. Not to say that Dan and our other sales counselors cannot answer a lot of the financial questions, but there are certain ones that Dan and his team will send to me or our senior director of finance to help weigh in on. And as I mentioned earlier, our business is actuarially based. We have a very comprehensive study performed on once every 3 years. It really helps us inform our business for the long run and our business decisions. On the governance and the community side, as you're going through this process, look at that board of trustees, look at their experience, look at their diversity. If you have a board of trustees that's made up of 12 accountants, that may not necessarily be the best thing. As much as I love accounting, you want to have legal, you want to have healthcare, you want to have IT, you want to have finance, you want to have other business savvy on there, because it plays off of each other. You want to look at communities that may have resident trustees, residents that have a voice and are able to have full voting rights on behalf of the community. What is their tenure from that? And good communities will provide a bio, a very detailed biography of their board of trustees. They're very proud of the individuals who volunteer their time to serve the mission. Keith mentioned earlier accreditation through CARF. Is your community a part of Leading Age, which is a national industry association? Very important for communities to learn from each other. If you have a community that doesn't necessarily do this, they may not be up on what is trending and what is coming down the pipe, and may not be as quick to be able to move into market changes. I mentioned earlier resident trustees, but also, although resident trustees have a vote, resident councils and or resident finance committees who represent the resident association, they don't necessarily have a vote on how the business is run, but they certainly have a voice. And, we make our best decisions when we're interacting with our resident council and resident finance committees. And I talked earlier about the benevolence clause. That's really specific to a not-for-profit and provides significant peace of mind to our residents. This here, what to look for, is kind of the opposite of what I just talked about. Mature communities that have issues, they don't have high occupancy rates. There's, for some reason, whatever it may be, there's not a strong wait list, or, residents are not interested in the marketplace. As your occupancy goes down, your entrance fee cash drops. It impacts your ability to reinvest in your building, which leads to an aging physical plant. If you have an aging physical plant, it's not really desirable. It's going to further impact your occupancy, and it becomes this spiral that is trending downward. You want to look at organizations that embrace change, and nobody likes change, but change is really important. And to be able to be vocal about that, and to understand that situations change, you have to be able to flex as you move forward. Looking at their balance sheet and their financials, if there's too much debt or not enough cash, what does the marketplace look like? And also, does the organization have the ability to access capital to fund new programming, or make capital investments, or to further its mission? Keith mentioned, I think it was less than 20% of growth in the next couple of years in the not-for-profit space will come through new communities. It's because they present a lot of risk. You have, I'm not even on here, but construction costs have gone up significantly over the last 2 or 3 years. Borrowing rates have gone up significantly, leads to higher cost and a higher debt burden. And then you still have the risk. You're building something. You have to make sure that when you have it built, that people are moving in because you've spent all this money. And then additionally, we have labor costs. Keith again talked earlier about workforce constraints, staffing, not just in the nursing area, but in the trades, in housekeeping, and in dining. There's risk to being able to bring new employees to your community. So just be aware of that. It doesn't mean that new communities can't be successful. It's just that there are headwinds, and you want to make sure that you know these up front before you approach a new community. As a transparent organization, and one that we want to educate you not just on RiverWoods communities, but others as you go through your journey, we have this insider's guide available to you, which answers a lot of these questions and really helps you plan for your next step. Just reach out to your sales counselor. They'd be more than happy to provide it to you. So we're going to get into a couple financial pieces here. It's financial ratio analysis. So Keith talked earlier about, Fitch and CARF and the accreditation. It's really hard to compare organizations face to face, but being able to use ratio analysis to go ahead and do that. I'll go into some examples for our communities here, but it really does start with occupancy. It's the lifeblood of the community. The more full you are, the stronger you are going to be, all else being equal. But as you're going through this, understand how the community benchmarks. Is it looking at those accredited CCRCs? Is it looking at rated organizations? How's it looking against its past performance, and what does its future performance look like? What goals is it setting, and do those goals make sense? So let's take a look at occupancy first. On the independent side, the industry considers 95% full capacity because there are always certain units that are being refurbished. Communities do have the ability to run above that, and those that do really have their operations together. They understand when an apartment's going to open up before it opens up. They understand how quickly to get their staff and their contractors in to refurbish that unit. They have a robust wait list, and the marketing and sales team is actively working that while the unit is being refurbished. So you can run at 96, 97, 98% occupancy. It's just more difficult to do that. Look at the trends over time. Is it going up? Is it going down? Is it pretty much steady state? If it drops, what is the reason to that? Maybe there were some additional units that were introduced into the community that took a little while to fill up. As long as it's explainable, it's probably not an issue. And again, the wait list. And I come from the manufacturing world. We used to call that backlog, but having a robust wait list for people ready to come in when a unit opens up is significantly valuable to a community. On the healthcare side, occupancy is just as important. Look at those trends. Our expectation for our health centers is to run at 90% occupancy. We don't expect 95 or 100% because we want to have those healthcare units available for our existing life care independent residents should they need that space. But we also don't expect to run at 80% either. There's a sweet spot in the middle at about 90% healthcare occupancy. Ask how the community approaches that. You know, how do you manage the transitions from the different levels of care? You want to look for a process, but you also want to look for a process that it gets to the end game of if you do need a higher level of care, you really should be in assisted living or memory care. And the staffing the same way, because healthcare staffing is incredibly expensive, and that probably will not change in the near or long-term futures. So getting into a few financial ratios, and we'll wrap it up here. You know, really 3 measures to look at, and I think about margin as the income statement. And yes, a community can make a surplus or a profit. A not-for-profit doesn't mean no profit. A not-for-profit means that any margin it generates goes back into the business. It doesn't go to an external stakeholder. We'll show you a net operating margin in a second, but this is the core operations of the business. So it's cash revenues coming in from residents, and it's cash expenses to provide services to those residents. Very, very core. It's the stuff that you can most impact. Liquidity is a hybrid between the income statement and the balance sheet, but it really is your flexibility. I mean, think about it. If you have liquid cash, if something comes up, you have the ability quickly to make a change in your operating model should you have to. The measure we use there is called days cash and unrestricted investments on hand. I'll show you that in a second as well. And then the last measure, really the balance sheet or capital structure. The 2 biggest balance sheet items for a continuing care retirement community are its unrestricted cash and investments position and its debt load. So we'll show you that as well. Dan? So this just happens to be RiverWoods Durham. The reason there's only 4 bars here is, as Keith mentioned earlier, Durham will be celebrating its 5th anniversary of opening this coming November. So we only actually have four years of results of audit of really fairly normal operations, and actually fiscal 21 here, a negative net operating margin, but the community was still brand new. We were in the middle of the pandemic, and we purposely chose to delay opening our healthcare center because of the pandemic. So you can see the operations the first year was negative, but this community in the next 3 years has grown its balance sheet and its P&L significantly. So again, when you're looking at these, don't just look at the absolute values, but look at the trends as well. Next one, Dan. This happens to be RiverWoods Exeter liquidity, and you'll notice we put 10 years of data on here. We could have easily done 30, but it would have been an eyesore. But you know, RiverWoods Exeter, days cash on hand and its unrestricted investments as well, over 600 days cash on hand. So essentially what that means from a flexibility standpoint for Exeter is if it had some event that came up and said, we can't take another dime of revenue in without making any change to our operating structure, we could exist with our balance sheet for almost 2 years. That's peace of mind. That's flexibility. Now, no organization would ever run it that way, but that's just the interpretation of how strong this organization is. And then lastly, capital structure for RiverWoods Manchester. Remember, these are the 2 biggest items on the balance sheet. 10 years of data. You know, you can see the significant improvement for RiverWoods Manchester. Keith mentioned earlier that Manchester was a struggling community prior to affiliating with the RiverWoods Group system in 2016. So you'll notice that in fiscal 2017, the first year within the system, Manchester was able to significantly strengthen its balance sheet. It made major capital improvements in 2018 and 2019 to modernize. It had deferred maintenance prior to that. And then, as you can see from that point on, it has continued to grow its balance sheet in relationship to its outstanding debt. So really a success story for that community. And then lastly, other best practices to think about as you're going through this, as you're looking at organizations, do they close their books monthly, and do they make that monthly report available? We like to be able to do that because our managers are making decisions on a monthly basis. And our board is looking at this. We like to say we're pre-worriers. We'd rather have the information out there and understand what's going on and be able to make quick decisions if we need to. Does the organization have a robust quarterly reporting package, whether it's on Emma or it's something that's made available to external stakeholders? If the organization makes that available to prospective residents and people on the wait list, that's a big step into understanding how the organization is operating and how transparent they are. Do they have a documented financial philosophy of how they run the business? What other key ratios do they look at? I talked about 3 key ones here, but we track 10 key ones in total for us. And while some have varying degrees of importance for the community in any given year, we believe that having a nice bag of ratios to pull from to make sure that it's appropriate for the business is really important. Along the transparency lines of being able to have all resident meetings. So not only talking with the resident council and the resident finance committee, but all residents, and talking at a level that non-financial people can understand. So it's a balancing act. I mean, we want to talk about the financial strength of the organization. All communities that are strong want to do that, but you have to do it in a manner that reaches the largest audience. And then I talked earlier about residents on the Board of Trustees. So Dan, I think with that, I'll turn it back to you.
Thank you very much.
You're welcome.
Kevin, and thank you, Keith, for some great details, information. As people may have already known, there's a lot to learn when looking at a continuing care retirement community like RiverWoods or others in the area. So we're going to try to get to a few questions, try to scroll through and get some that are really going to be good questions for everyone on the call. Kevin, do you want to talk just a little bit about medical deductions based upon RiverWoods? Because I know it's a question many people generally ask.
Yeah, absolutely. So typically in the not-for-profit world, a portion of your entrance fee is tax deductible as a medical expense in the year that you put your contract in force with a community. And normally that amount is the amount of your non-refundable entrance fee, just the non-refundable portion, but it's usually pretty sizable. From an ongoing monthly service fee perspective, typically when you are in any level of care above independent living, 100% of your monthly service fee is deductible as a medical expense. And while you're in independent living, a portion of that is deductible. And that portion, usually it ranges between 30 and 35%, depending on the community. Some are different, and it does fluctuate every year. But a portion of your monthly service fee while in independent living is providing for future healthcare expense. And again, that is more for the type A, type B communities. Type C, it's pay as you go. It would be 100% only when you get to the higher levels of care. And again, we don't give tax advice. We have engaged an outside consultant to work with us on this calculation, but everybody's tax situation is a little different. But in general, a portion of your entrance fee and your monthly service fee is tax deductible.
Great. Question for Keith. Besides scale in technology, what has caused stress in the nonprofit space? Is it regulatory guidance, rates, government reimbursement, schedules? Can you share any light on that?
Yeah, so I would say reimbursement is certainly not necessarily helped for those that do rely upon third-party reimbursement. I would say the number one driver for financial distress in the sector really across the board has been occupancy. As Kevin mentioned when he started his section, organizations that are full generally are able to pay their bills and reinvest accordingly and thrive. The organizations that are, well, frankly, if they're small, but then if occupancy starts to decline, even at larger organizations, starts to introduce the risk of financial distress. Oftentimes you have a little bit of a runway if there's an occupancy decline. I think everybody experienced occupancy decline during COVID, but ultimately those who are able to refill back to stabilized levels are fine or are going to be fine. But as occupancy, if occupancy dips and ultimately an organization will stop reinvesting back into the campus because cash flow concerns, that creates potentially a death spiral. And we've seen that on more than one occasion. So for me, it all goes back to occupancy.
Good. I guess, Kevin, this could go to you. There's a couple questions kind of deal with the same thing about financial qualification for a community. What type of software or how do you acute other expenses outside of Riverwoods expenses to find out financial availability of the community?
Yes. So we use an actuarial software. We were two prominent actuarial firms that work in the senior living space. So we work with one of the two. Runs multiple scenario analyses for us to understand our risks, and obviously there are assumptions that go into that. We will make assumptions based upon a typical single or a couple from expenses outside of RiverWoods, but we typically will ask and if there are additional budgets that you all have that you want us to use for non-RiverWoods expenses. We will make conservative assumptions for monthly service fee increases. So we typically will assume that fee increases go up 5% every year from an actuarial basis. We prefer to be surprised on the upside, as I think you would as well. But it is really a very in-depth actuarial analysis that we go through for each of the communities. And then we get a summary and we look at that. And what I would say is, for you all, if you have financial advisors or if you are somewhat financial savvy, look at it on your end as well. We are approaching the risk from an overall organization. So for example, RiverWoods Exeter has over 600 residents. So we may make a decision based upon risk for one individual that is fine in the grand scheme of 600 lives, but may not be appropriate for you. So we get asked all the time, well, can you tell us what we should do on this? And it's really a personal choice. We have measures of where we feel you will fit in, and again, with conservative pieces. So, don't hesitate to reach out to your trusted allies and your estate planners as well to work through it on your end. Usually they come out pretty close. Usually we're more conservative and your financial planners are more aggressive, but the answer is somewhere in the middle on that. And we want you to be comfortable. I mean, at the end of the day, we have to protect the business, but we also want our residents to come here and feel comfortable and enjoy all the amenities. We don't want it cut so close that you can't enjoy all that RiverWoods has to offer.
I'm going to get to a couple more questions because I know Keith has another commitment here. There was a question, I'm not sure how specific, but how many CCRCs are there? You said about the Boston market, but how about New England, Keith? Can you kind of give us a sense of how many they are and kind of the ratio of for-profit, not-for-profit?
So CCRCs that are, I would say, comparable to a RiverWoods, there's probably in the Northeast, so Massachusetts, New Hampshire, Vermont, and probably 24 that I would say would be close to comparable to RiverWoods. There are some that meet the definition of a CCRC, but really aren't comparable. Yeah, so I think that's the right number. I would, other than Connecticut, so Connecticut's about 40% for-profit and 60% not-for-profit. In the rest of the Northeast, it's roughly 75% are not-for-profit, 25% are for-profit.
Great. Kevin, I guess a question about hiring, retaining quality care providers. How is Riverwoods addressing this issue from a salaries, benefits compared to other same organizations?
Yeah, it's I won't say it's been a struggle, but it has really generated a lot of our attention over the last 3 to 4 years, especially. We watch the markets incredibly closely. We try to be proactive. We have had sizable wage adjustments specifically for our LPNs and our RNs, as well as our nursing assistants. In New Hampshire, they're licensed nursing assistants or LNAs. Some states they're called CNAs. But we have probably seen those rates increase about 50% over the last 4 years, rough numbers. And while that may seem like a large number, it is a large number. But what we're really proud of is the LNAs, especially, they now are making a very livable wage. That's a very tough job to do on a day-to-day basis. And when those positions were paying $14, $15 an hour, that was really tough for those individuals. So we are proud that we were able have been able to bump that up significantly. And what it means is we rely less on agency nursing, which typically comes at a premium, which costs our residents more, and it provides better quality for our residents, because if we have the nurses and the LNAs on our staff, our residents are seeing the same people day in and day out. It's not a different agency nurse that is coming in to fill a shift for us because we were understaffed. So it's a balancing act, no doubt. But we've made a conscious decision to be in the 50th to 75th percentile market rate, not just for CCRCs, but for any profession that is hiring nurses, and that has worked very well for us. And the cost of not having to recruit as much as we had been in the past is also a benefit to the community.
Great. A lot of questions, and I'm not surprised about skilled nursing care. I guess that we'll kind of go to both Keith and Kevin. Is there any thoughts, I guess, Kevin, about eliminating skilled nursing care, and what are the benefits of a community that has it? I know you talked a little bit about that. I don't know who wants to kind of answer that question.
Yeah, I'll take that. So, skilled nursing really refers to the subset that is governed by Medicare. So think about it as your I mean, it's the skilled nursing, it's the OT, the occupational therapy, the physical therapy, the speech therapy, and we can still provide that without being skilled nursing or Medicare certified. And that's the same with the overall nursing care. So while Keith said most organizations many organizations are not going the skilled nursing route, they're choosing not to get Medicare certified, but they're providing the majority, if not all, of the services still with an assisted living license, as opposed to a skilled nursing license, meaning you're still getting nursing care within the community. You're just not getting that skilled portion if you needed to go out if you had a Medicare stay. And from a perspective standpoint, in Exeter, which is the only community that has skilled nursing, that is skilled nursing certified, we have significantly reduced the amount of our skilled nursing beds because we were paying all the administrative cost to them, but it generates less than 3% of our revenue, and we're still able to generate that 3% and service all of our residents in-house, but with significantly less skilled nursing beds. So we and other organizations can still care for you for most, if not all, of your remaining life. It's just if you do have a Medicare event, you would have to rehab initially outside of the community.
Perfect. Thank you so much. It's coming up to 10 after the hour, so I know we're going to have to let us Keith go, but thank you very much, Keith, for joining us today. Kevin, thank you very much for taking some of the questions. If you have additional questions, certainly there are a variety of ways to get them answered through your senior living counselor, or submit a question through our website, which is riverwoodsnh.org. If you're looking for financial statements, our philosophy at Riverwoods, as Kevin was mentioning, it is available on our riverwoodsnh.org website to find that information. We also have really good programming that happens pretty much monthly with Riverwoods on a variety of topics, whether it's financial, downsizing, real estate, which is a very big topic in the industry, diversity, equity, inclusion, and more. So just again, go to riverwoodsnh.org to events. You can see what's happening in our communities. But again, thank you all for joining us today. Hopefully you learned some really valuable information. Again, to Keith and Kevin, wish everyone a wonderful day. Hopefully everyone's enjoying this beautiful late fall season weather. Thanks again. Have a great day.
Thanks,
Thanks,
everybody.
everyone.